Welcome back. You're still watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. In a recent report by Moody's, the ratings agency highlighted energy shortages, low commodity prices, drought, and a weaker than expected global growth as reasons why South Africa's economy is likely to remain constrained over the next 18 months. We've already seen a 1.3% contraction in the GDP over the second quarter. Meanwhile, over the past few weeks, China's ability to continue spurring global growth appears to be on shaky ground. But could this be the end of the world? Does it mean that we've reached the end of the supercycle? Joining me to discuss this matter and look at what this really means for South Africans are Stephen Meintjies. He's the head of research at Imara S.P. Reid, and John Loos from F&B Household and Property Strategist. Gentlemen, thanks for your time. Let me just start with you, John, being on right across from me. Is this the end of the supercycle that we've become so accustomed to? The party's over.
I think so. I think the end was probably delayed somewhat. In 2008, thereabouts was possibly the end. But we had one more bit of ammunition. The world had ratcheted up its debt, or the developed world had, and got sort of to a level where that was really becoming a drag. Too much debt eventually becomes a problem. They could throw one last thing at it, and that was to provide big stimulus packages. And some countries, more emerging market countries, since then have ratcheted up the global debt to GDP ratio even more. Yeah. But that's now reaching a point where we can't really go any further. So now it's time to take the pain, if it may, or not necessarily pain, but it can just be you get these long stagnant periods where you have to sort out your issues. We've sorted out to a certain extent the global energy supply issue. I'm talking oil and shale gas and so on. That's been alleviated. Mm. But this big debt to GDP burden still remains. Debt burdens cannot be sorted out overnight. They normally take a good long time. And in the meantime, I think that's going to be a big drag on global economic growth. And for South Africa, of course, being very much an open economy, that would be a big drag on our growth as well.
Stephen, you agree the party is over. And maybe just to get a sense from you, what are the telltale signs that things really are not looking good? John talked about high debt to GDP ratios. What do you look at?
Well, I'd like to pick up John's point about sort out issues. And we've had the spectacle in the Eurozone of the core members browbeating the unfortunate peripherals into structural reform. Now, in a way, they're lucky they had Big Brother in Berlin or whatever to get them to do that, because those are things that one has to do. So they have been sorting out their issues for a few years. Now, the emerging markets actually need to do that, because they kind of squandered the opportunity in the boom time to do good reforms. And so now the emerging market, most of them, some of them are actually biting the bullet of reform, but most of them are going to have to bite the bullet of structural reform. And if they don't do it, markets will kind of force them to.
John, everybody says that this is a cycle. Things will eventually turn. But how long do cycles last? The cycles like this, are we talking about 5 years? Is it 10 years? And where are we in the cycle? I think that will maybe help us put things into perspective too.
The super cycles can be a lot longer. They can be 15 or 20 years from bottom to bottom or top to top, or possibly even longer. The last big stagnating part of our economic growth super cycle was arguably through the 70s and the 1980s to the early 1990s, where we ended up with just about no growth. And while that's happening, while that economy is stagnating, it was precipitated in the 70s first by a global slowdown and oil price shocks and all those nasty things. But then it spills over to local factors. It starts driving up social tensions often. And it's done so again since the end of the boom years in 2008. You see it in service delivery protests, you see it in strike action, you see it in the anger mounting in a lot of ways, because people's quality of life is more under pressure. So that happened in the 70s. Then it starts creating heightened political instability, and by the mid-70s, I mean, that was almost, you could say, the beginning of the end for the previous government. The economy got worse, the anger got worse. That drove the economy even more down until you got to some big political realignment in 1994, and that's possibly the process that has to happen again. I think we might be on that path again. heightened social tensions, more disruption to the economy, more stagnation, and eventually till it gets to a level where you have big breakups in politics. I don't know how they break. It's very unpredictable, and you have new realignments, and then investor confidence is restored, and people calm down and give this new alignment a chance, and then off you go again, something like that. But it can be a very long process.
Stephen, where to run? Investor confidence needs to be restored. As an investor now in this cycle, where should I be putting money?
Well, there are, whatever it is, let's say 5 or 100 companies listed on the JSE. If we had an economy that was optimally managed, shall we say, business-friendly, growth-friendly, there might be double that number. So the fact that things are going along at a very slow rate as far as the economy is concerned doesn't mean to say there aren't going to be companies that can still make money and still do well for their shareholders. So I think, and also one needs to look at China. Yes. I think there's a lot of uncertainty about what's going on there, and in fact people are in this right now saying that maybe there's no growth at all. I think that's probably a bit far-fetched, and I think within maybe the next 6 months we'll get enough hard data out of China to see where they are actually at.
Do you trust their data?
Well, nobody does, but you can't deny the vibrancy and the physical activity in China. I mean, it's there, it's real, and it's not going to disappear. So when we get a better idea of where they're at, I mean, if they're only growing at 4%, I mean, then that's a very positive number. So I think eventually there'll be some calm and a more rational assessment of where China is. They don't have to be booming for the global economy to, the global economy is probably still going to grow, even so. And once we get clarity on where China is, I think that'll restore confidence, even if it's growing at a lower level.
Wayne McCurry is one of the analysts that we also used on the show, and he said everybody talks about China, but and they said slowing economy and the slowing growth, but there's still growth, and we need to highlight that.
Yes.
John, let me come to you about where we should be putting money. As Stephen said, there's a lot of uncertainty around China. So for the property sector, what does this mean? Is that a place that could potentially be a safe haven or not?
It's sometimes a little bit less unstable than the share markets, for instance, that take poundings quite quickly or quite rapidly. But no, I mean, I'm not sure that property, even in property, I think we're into the downward phase, going into the downward phase of the super cycle. That would mean a real house price correction over time. So it doesn't say you can't invest in property, but it's about looking for structural changes in property within our major metros. The major metros are probably the most stable property markets, and then within them you start looking for structural changes like public transport corridors, because we are congesting. We are moving, I think, in the next number of years towards much more of a public transport culture. It's back to that location thing. So it's back to a situation where even in the tougher times, I mean, the clever investors are going to make money out of property. But no, you can't just throw your money into any property like in a boom time and think you're going to create a good return. That's not that easy. It's clever investing once again.
Stephen, while we wrap this up, what is the final word that you would say to investors at a time like this? Everybody says don't panic. Are you in the same boat?
Absolutely, and I think one should recognize that foreign investors have been told by their strategists to sell emerging markets. There's an emerging markets bloodbath coming. And that means a lot of foreign investors have to sell South African shares. That gives us opportunities.
Stephen and John, thanks so much, gentlemen, for coming in and putting things into perspective for us. Don't panic. Thank you to Stephen Meintjies. He's the head of research at Momentum SP Reid, and John Loos from F&B Household and Property Strategist. That's all for this week's edition of Finweek Money Matters. Do remember that you can go and get yourself a copy of the magazine. It's available at your nearest store, but you can also get a copy online. Until next week, same time, have a great weekend.